Well, thank you, Matthew. Good morning, ladies and gentlemen, and welcome to the World Exchange Congress 2012. Today is my privilege to serve as your chairman. Our conference theme this year is growth on a global scale. Istanbul is the ideal location. Here, East meets West. Turkey is strong and growing. In 2011, in June, Turkey was promoted to advanced emerging country status by FTSE, the global index company. And this year, 2012, is the 30th anniversary of Turkey's regulator, the Capital Markets Board, and we're very honored with the presence of the chairman in the room. Welcome and congratulations. In fact, the Capital Markets Board chairs the important Emerging Markets Committee of IOSCO, the International Organization of Global Securities Regulators. Ladies and gentlemen, gathering at this year's World Exchange Congress are distinguished delegates and speakers from 50 countries, 50. We wish to work in a spirit of partnership to promote liquidity and new business, and we thank the regulators because they provide the framework within which we can behave as entrepreneurs. So let us begin with a review of the size of the markets. And ladies and gentlemen, if we look at the first slide, we have a summary of the size of financial assets worldwide as of the last peak, 2008, peak in terms of the crisis. You can see the largest amount of assets are in the United States with 55 trillion, the Eurozone aiming to be a single market with 42, but of course, the second biggest single country, Japan, at 26 trillion. If we look over the last 20 years and remember 1999, the peak of the internet bubble, we can take a look at seeing that from the far left, the assets have grown from about 50 trillion to about 212. You'll notice in the middle of this slide the red circle around the 175 trillion of that 2008 slide we just looked at. So look at the list of the classifications of financial assets. There was under that 175 about 34 trillion of the stock market, about 32 trillion of public debt outstanding, and various other fixed income non-equity size. But the key insight is that by 2010, we have an overall size of financial instruments in the world that has surpassed the last pre-crisis peak. In 1999, the height of the internet bubble, we saw significant cross-border flows, but if you look at the directions of the connectivity, they were broadly between North America and Europe, and Japan and North America, where the size of the bubbles and the numbers in those bubbles represent the total financial assets. That was 1999, and 10 years later, 2009, we can see the globalization of the international cross-border flows increasing, particularly from other Asia, Latin America, Middle East, Africa, rest of the world, Australia, and New Zealand. If we look, interestingly enough, at the relation between the over-the-counter derivatives markets and the exchange-traded derivatives markets, we can see over time the growth of the open interests seems to correlate with one another. But what's very interesting is that the big numbers we read in the press, about $600 trillion of over-the-counter derivatives, seems to be a much larger number than the 80 trillion of open interest in the exchange-traded derivatives market. But of course, ladies and gentlemen, if you're involved in the exchange space, it's not just about market size. It's about turnover on the various systems to provide liquidity. And what the next slide shows, just highlighting the difference in the open interest of the 600 trillion versus of the over-the-counter derivatives versus the 80 trillion of the exchange-traded derivatives. Compare that open interest with the turnovers in the market. So at the far right of the top slide, that 80 trillion of exchange-traded derivatives seems to be turning over about 2,000 trillion of notional. If we look at the bottom right of this chart, the 600 trillion of open interest derivatives turns over about 1,700 trillion of turnover. So question, why is this smaller amount of exchange-traded derivatives generating so much more turnover than the traditional over-the-counter instruments? Well, the first observation is the nature of the products. The fixed income products implemented on exchanges tend to be in strips, packs, and bundles. But the clear driver is the fact that exchange-traded derivatives tend to have a very short time to expiry with lots of rolling, where more often the over-the-counter derivatives may have contracts that last much longer to expiry. And if we take a look at the growth and segmentation of this over-the-counter derivatives markets, you can see on the bubbles during the crisis of 2008, the vast majority, the largest bubble, was the interest rate swap market. Then a significant sized bubble in the credit default swaps, which on the right you can see the dramatic growth in the size of that market, and a material minority in over-the-counter exchange equity derivatives. Last year, one of our speakers put up this slide to highlight at the far left the geographic segmentation of these markets. And the clear insight was that if we looked at Europe, US, and America together, that represented about 80% of the over-the-counter derivatives. In fact, the UK is about 2/3 of the entire European size. So the clear insight is that from a framework perspective, if we take a look at the size of these markets and the direction of regulatory travel, we may see whether there are some opportunities, not just to make the market safer in the over-the-counter framework, but also to see whether or not there are opportunities to identify products and trading strategies that may have more affinity for an exchange model. And of course, we recall what happened during 2008. On the far left side in the over-the-counter markets, the two dealers facing off to each other that then had their own range of clients. If one dealer went down, you opened up potential for systemic risk. The solution was to introduce a circuit breaker of a central counterparty with some cushion capital to try and solve that particular puzzle. Clearly, the equities markets has been informing the regulatory framework because here on this chart, 2008, the height of the crisis, at the top left, the value traded on exchange order books of equities had an all-time record of $120 trillion. What was special about the equity markets during the crisis? We had prices, which gave us valuation to calculate margin in the central counterparties, but really, with short time to settlement, there's not as much risk, but there is clearly a straight-through processing model that works. At the bottom right of this chart, you'll see Shanghai and Shenzhen. The numbers are about, say, 2.5 trillion and 1.2 trillion of order book activity. If we take a look in 2010, you can see the dramatic growth of Shanghai and Shenzhen at the bottom right. Another insight, the rise of China. In fact, if we take a look at the capitalization of markets like Shanghai in pink, you'll see that the value of stocks listed on Shanghai are beginning to approach those of international markets like Tokyo and London. That is the market capitalization. But if we look at the notional order book turnover, we'll notice that already Shanghai and separately Shenzhen have had months where they have reported more order book turnover than international markets like London and Tokyo. The insight, ladies and gentlemen, is that in a world of technology and a world where regulators can set best practice, there is the potential in one step to go to state-of-the-art. And really, the last 20 years are the years of the internet, the electronification, the introduction of the most recent market structure that we're familiar with. This chart over the last 20 years is showing the trillions of dollars of equities value traded worldwide, globally, and broken down regionally. Yes, we can see the peak and bursting of the internet bubble, But the clear insight is that with the introduction of the most recent algorithms, the value traded on exchanges has now dramatically surpassed that of the peak of the bursting of the internet bubble. And just to finish on the final slide of this introduction, ladies and gentlemen, here are the most recent World Federation of Exchange statistics. At the far right, you can see the tall navy bar highlighting the peak value of electronic order book trading on equities exchanges worldwide. And the key insight is that every year since, including last year, 2011, we are still 30% below the peak. Another interesting observation is if we look at the geographic segmentation of Asia Pacific and EMEA, 2009 was the first year since modern records began that Asian exchanges are recording collectively more order book turnover than European ones. So ladies and gentlemen, with that quick tour of size of markets and some of the trends, just to leave a taster for what may be coming ahead, allow me to introduce our first distinguished speaker. Ladies and gentlemen, our next speaker, when he wrote his book, Confessions of an Economic Hitman, it was rejected by 30 publishers. But then it ended up on the New York Times bestseller list for a year and a half. And today, it's still being published in 40 languages. There must be an insight about playing the long game. But ladies and gentlemen, allow me to introduce our distinguished first speaker, John Perkins, to talk about what wrecked the economy and how to fix it. John, ladies and gentlemen, thank you very much.